Welcome to Connect, the podcast for California MBA, where strategy, innovation, and leadership come together to shape the future of mortgage finance. This is where the voices and ideas driving our industry forward meet real world execution. My name is Paul Gigliotti, CEO of the California MBA. And if you're here, you care about building better for your business, your clients, and the future of housing. Before we begin and jump in and start chatting with our guest, I want to take a moment to thank our 2026 President Council sponsor who makes conversations like these and all the advocacy and legislative initiatives that we work on possible. So a big heartfelt thank you to AmeriHome, Consolidated Analytics, Loan DNA, Funding Shield, CMG Financial, Guild Mortgage, Rocket Mortgage, Wiener Brodsky Kidder, and Western Alliance Bank. Thank you again for your continued partnership and dedication to the California MBA and our industry. So today, I am thrilled to welcome Lisa Schreiber, Senior Vice President of Correspondent Lending at eResi. Lisa, thank you so much for being here.
Oh, absolutely. And Paul, I've got
Oh,
my
cheers.
California MBA Connect cup with me. So
Thank you so
thank
much for
you.
on point with your branding and the ability to take a sip. Lisa and I go back quite a bit. We did a lot of work at my previous organization, Prudent AI, where I'm still an advisor and touch on, and Lisa is a great supporter of that solution. And also has been, eResi and Lisa have been supporters of the California MBA since I can remember. So I love jumping in these conversations, with people that I really know and understand what your passion is in the industry. This is going to be a jam-packed content conversation that we have. Lisa's known voice in the industry with deep experience across non-agency lending, correspondent lending, fintech, product development, operations, training, lender adoption, and being known as an all-around awesome person. Lisa has held senior leadership roles across mortgage lending and technology platforms and brings a unique perspective on where the market is going, not just from a product standpoint, but from a standpoint of execution, education, consumer sentiment, and mortgage-backed securities. So with that, Lisa, are you ready to dive in and share all the goodness that you've got in your head?
I am ready to rock and roll.
All right, let's go. So I want to open up with more of like a big picture conversation. The mortgage market has been really challenging, and a lot of that challenge is based off of consumer sentiment, expectation of interest rates. And I think some of that is also based off of the consumer's needs changing. And we'll dive into that when we talk about non-QM products. Um, but we also have another huge challenge, and that's affordability. And that's hitting a square in the face in the industry and in our economic system in the nation as we know it. Inventory is uneven. Rates are not coming down to what the consumer wants, that 4% or 3%. Um, and lenders are trying to find responsible ways to serve more consumers. So, Lisa, from your vantage point, where does non-agency lending fit in the marketplace that we just described, today's market? And I can't wait to hear your answer on this or your response to this. What do you think lenders sometimes misunderstand about non-QM or non-agency products?
Great questions, of course. I think just to get started around the word affordability, generally you wouldn't associate necessarily affordability with the non-agency or non-QM products, just because people think of them, and rightly so, as products that generally have quite a bit of equity, right? So the average borrower is at that 70% LTV. We talk about that all the time. What does that
Mhm.
borrower profile look like? But there's also aspects of the programs that are very relevant today, beyond the fact that you can get a loan for somebody that doesn't qualify in the QM space.
Mhm.
The investment bar, the investment portfolio person that has a lot of rental properties. You hear all the time. Is it better to rent or buy? And right now, for some people, it is better to rent. So, in two ways, you've got an investor that is purchasing these homes, fixing them up, and then creating a rental market in the several areas. And then that gives the ability for people to have housing that they can afford. Now, that doesn't mean that they own the home, but it is providing that rental opportunity. So you've got investors that are providing that rental opportunity. And then, of course, the one thing that we don't talk about as much is equity. So often people have equity in their homes, and even if they got that first mortgage at an extremely low rate, they may be tied to that mortgage because they don't want to lose that rate. But they've got second programs now, HELOC programs now, and they're more widely available. You can use a bank statement analysis to get a HELOC or a second, not just that, normal QM style program. So tapping into your equity, ability to be able to afford to do things through equity, and then certainly investor opportunities for rental property programs.
Those are great responses, and you kind of touched on everything we talked about in the opening remarks. I think what's really important as we're going through this conversation, we have to think about who the consumer is, right? It's no
Mhm.
longer June and Ward Cleaver, that work 9 to 5 with a W-2 job. The Great Migration, which was offset from COVID, really brought this concept of people earning income from multiple streams, right? Like a W-2 job and then having a side hustle. And that was before we hit this inflationary period. That was just the way things were. And so these products that you were talking about, when you talk about bank statement analysis, yeah, an Uber driver is going to make a lot more money on their bank statement for qualification purposes than they are on their tax return in a conforming loan. And for me, that's where the I hate to use this phrase, I can't think of anything else, but the nugget is for when we talk about today's market from my perspective.
Yeah, you had mentioned a question about, what are some of the misnomers or things that people
Yeah.
don't consider. Um, we go back to what I just said about people that are investing in rental units. That is another way to gain income, right? So maybe I'm a W 2 employee, but maybe I'm worried about that, or maybe I just don't make enough money today to afford things. Having extra income from a rental unit is another way. Real estate agents that every one of our loan officers work with all the time, out in the industry, those real estate agents are often investors as well in properties. Then, of course, we this is a hot topic, right? Especially in 2020. Everybody became an Uber driver or a gig worker, selling things on eBay or, just to get extra money. And so all of those people are people that we target. We've been kind of trying to come up with a better name than not QM. Even
Yes, that needs
right?
to happen.
Yeah, it definitely needs to happen, and honestly, I think I just need to make it happen somehow, right?
Yes,
But,
I will champion you behind that. I think that's a great
yeah, we
idea.
should we should get together as a group, right? And try to
And
think of this, brainstorm. We call it the entrepreneur loan, the boss
yeah,
loan, because really that's what it was. People with self-employed. I was a consultant for many years. Same thing when you're a consultant or anybody that works for themselves, a Schedule C or whatever, LLCs. You know, y- it doesn't tax returns don't necessarily represent because you've got expenses and everything else.
right.
So, cash flow, analyzing the cash flow of both people that have rental programs, have businesses. This is the highlight of these programs and why they work so well.
Yeah. What I love about this conversation is we're naturally moving from affordability to accessibility. So at the California MBA, we're always talking about access to credit, whether it's from an advocacy perspective or when we're having conversations with GSEs or organizations like eResi, having access to that credit for those borrowers that you're talking about that fit inside or that don't fit inside the mold, but fit inside the entrepreneurial spirit, multiple lines of revenue, whether it's Uber driving gig economy or doing side jobs, right? And on your tax return, you're obviously going to pay less in taxes, so you're going to have expenses hit that income. And so I love the fact that we're naturally moving into accessibility. You know, one I think gosh, Lisa, I can't remember who it was that I was having this conversation with, but they were talking about statistics of default rate for non QM versus QM. And the non QM was actually on the higher or lower end, less
That's right.
default, but a better percentage. And really, what we started to go through in that conversation is we started to break down who that consumer was, and those are most usually consumers that are more I don't want to say more savvy with their money, but they really watch their money because they do have multiple lines of income coming into their bank account and multiple expenses. And they have that entrepreneurial spirit where, oh my gosh, I need to make more money because
Mhm.
of inflation or rising gas prices or cost of, food, or I lost a consulting role. And those are the people that actually know how to or might have a better opportunity, I should say, in going out and bringing in more income because they're used to that lifestyle. That
Right.
was the
They
response I
hustle.
got. Yeah, yeah,
Yeah, right? Like, I think that's it. If you really think about it, like, your standard, your steady Eddie, the person that's a teacher. I have 2 teachers in my family, and they have great jobs and they do well. They actually do well because they're in Maryland, and not all teachers, some of the teachers actually in this country do pretty well.
yeah.
Obviously, they do an amazing job, but generally, they're used to working their hours, and they don't really a lot of I maybe the I'm just trying to think of how to say this without I a lot of people just have like a steady income, 9 to
Right.
5 type of job,
Yeah,
and the mentality of somebody like that versus the mentality of somebody who's just like always hustling, right? Like
yeah.
I have a lot of balls in the air, but we saw that actually happen in 2020. So when people really did go home and some people lost their jobs, we saw that the people that had the bank statement loans, for example, they were still
Mhm.
paying. We were
Yeah,
not having problems with performance. They weren't necessarily asking for modifications because they went out and they did some other side hustle just to make up the difference. It was a very interesting, almost like a psychological study, right?
yeah,
Um,
yeah.
and so that's what it taught us. It taught us there was a need and these people were a good risk.
Yeah, I think it must have been the conversation I was having with you because that's exactly what the precipice of the conversation was. It was the
Mhm.
mentality of the individual who's used to always having to find ways to bring money in that entrepreneurial
Mhm.
spirit. It's neither here nor there, nor good or bad. They both have pros and cons, but
Yep.
when it relates to, oh my gosh, I need to bring money in the door, sometimes it's easier for someone who is an entrepreneur to figure out different ways to do that without having to say, "I need, an extension on this debt," right?
Right.
Um, One thing that I do wanna to touch base with you on, Lisa, because I don't have too many individuals, on our Connect podcast. It's more IMBs and technology. So I really wanna jump into, correspondent lending and execution. I think that's something interesting to chat about what you do at eResi, in this role, which means you see the market from a very different perspective, very different point of view. Lenders may like the idea of expanding product offerings, but the execution is where it either works or falls completely apart, whether it's pricing, guideline, documentation, what's needed in underwriting, investor expectations. Like that's a lot to handle. I remember that from my days at Pinnacle Home Loans. Where do you see lenders getting it right in regards to those nuances that make a sellable loan? Pricing, guideline, documentation, underwriting, investor expectation, loan quality, et cetera. Where have you seen lenders be able to really pinpoint and get it right? And where do you see the biggest execution gaps when lenders try to build or expand non-agency production? I think that's really important because I see a lot of agency lenders moving into that space quickly.
Yes, definitely. So where I see lenders getting it right is first it starts from the top. Quite often the leadership isn't quite sold on non-agency for whatever reason, whatever, past experience they might have, or they just, maybe aren't as educated on how the programs could be utilized or really how to handle the risk around it, right? So we talk quite often to our sellers about where is your risk tolerance. If you want to be a seller where you close your own loans, which is who we deal with, non-del and delegated clients, then we talk to them about options. Do you want us to underwrite the loan for you? And how are those rep and warrants? Is that really important to you? If it is, then we can offset some of that credit risk for you, if that's your concern. If that's not necessarily your concern, but you really still want to have somebody check your loan before you close it, we have pre-close options that we work with our TPR partners on. Then, as you graduate and you get more and more comfortable, you've got underwriters that you feel good about, and you're seeing loans purchased quickly. We also then talk about, okay, what's your next step? Your next step might be to create your own guidelines. And we work with sellers to create their own guidelines and the acceptance that we would have of those guidelines. Where might we not align? So we define that with them. And then if they can even go further and they can actually do their own due diligence, and we create a reseller reliance process with them. But I
Mm,
think it really is about what level of risk do they want to take? What is their comfort level in underwriting those files and taking on any, of that credit perspective? And then truly the people that do well are the people that work closely with their investors in throughout that process, right? Like, we're partners here. Let's talk about where you are in development of these programs. Are you new? Are you scared? If you're new and scared, maybe start brokering. And maybe you're not my client right now. But then once you get the hang of it, you get more expertise, maybe you start creating your desk, or maybe you start bringing in tools like Prudent AI, we both talked about earlier today. There's certainly many tools out there right now. So the comfort level of the leadership, I think, is very important, and the structure of what they want to do within their organization. Because once they make that decision, then I think it's really easy to put that platform together, right? So say if I say, no, I want to take on the responsibility, I want to underwrite the files, then we say, okay, here's some of the tools that you need. Here's the structure that would be helpful for you. And in that partnership, we also work with them on structuring their docs, where you get your closing docs. Let's make sure your package looks right. Let's make sure you understand how prepayment penalties work. So I think it's that real partnership with whoever they're working with. And, it's not just me, right? For example, we generally get most of our money uh from the insurance side. KKR is our parent. But just, having the ability to have both a securitizer on, that you're working with, as well as insurance money, making sure that whoever you're selling to also has diversification, right? It's all of those things, which sounds like a lot, but it's really not that much if you're working with the right partner.
yeah. It's all about the partnership, and as it is in any industry, but specifically this one because there is so much risk, whether it's a non-agency or agency loan, right? And the interesting thing to me, it always has been about this industry is it could come bite you a bad loan years down, come back around to bite you in the rear end years down the line. It's not like an immediate thing. Once you're done, it's gone. And the consumer is paying the mortgage, and whatever happens, happens, right? Like, there's a default. Somebody's knocking on your door soon about, how did you underwrite this file? I noticed XYZ was missing from the file. Um, but I loved what you said, and I'll just, I want to bring this point up because I love what you said at the very beginning. It's a top down, right? So
Yeah,
if leadership, they really have to believe in this product.
they
And,
do.
knowing the industry, I could say, I bet there's a handful of leaders that look at what's occurring right now, and they see what the business eResi is doing, and companies like PennyMac and AmeriHome and Planet expanding their products to non-agency, and they sit back and say, "Well, I have to do this. I have to do this for market share." And maybe when it's a "I have to do this," then that is a leadership top-down mindset of, "Oh, well, we have to do this. We really don't believe in it." We're doing it for market share, financial, prosperity, as opposed to maybe someone like you or I who truly believe in the
Mhm.
non QM. I mean, I've bought two homes with non QM products.
Yeah, there you
because
go.
that's what was required at the time.
Uh-huh.
And I really don't think either one of those times it wasn't a financial hit, the interest rate, down payment, like it all washed at the end of the day. So I have passion for it. So that top down comment really resonated with me. I think you hit the nail on the head because I think in a situation like this, you've got to believe in it. You got to believe in the product and you have to deliver that to your team, not just production, but also operations, right?
Yeah, 100%. It's interesting. So, most of my family is in the business, which I blame myself for, because I'm the first one in my family in the business. But I spent a little time with my son-in-law yesterday, who's a loan officer, and he knows what I do, and we've been talking about this for quite some time. But he was working for a company that absolutely, positively was not into it. They're like, "Nope, we're not doing it. We're sticking with Fannie, Freddie, VA, and FHA. That's it. That's all we're doing." And so he went to a new company probably about 6, 8 months ago, that I've known and I really respect. I really respected his other company too, but, this company is much more open, and I think that they really they understand the programs. They've been doing the programs for a while.
Uh-huh.
So he said he was going to force himself to learn, right? So he said to me, he goes, I'm setting up a real estate agent meeting next week where I'm going to present non-QM. By the way, could you help me figure it out? Like, you got any materials, right? So I was like, "Oh my gosh," like, I was so excited, right? I was like, "Oh, I love this." So of course I
Yeah.
set up a bunch of stuff he and I had a long talk at lunch yesterday, and I said, "I'm just so excited that you're, like, looking at this now." And he goes, "I cannot believe that I haven't been doing these all along." He said,
Right.
"The bank statement program, it's just cash flow and everything else is the same." I said, "If I had a dollar for every time I have said that in the last 11 years, I probably could retire."
Yep.
And the DSCR, he just says it's really actually very simple, and he goes, "It all makes so much sense." And it was just blowing my mind, but because we've had so many conversations, but we did talk about that. We talked about the difference between the companies, and he just
Yep.
said, "We tried to get it in the other company, but they just wouldn't listen."
Yeah.
And now you can see it's like a recruitment and a retaining,
Yeah.
tool, because, he knew he couldn't do for his borrowers what he needed at the other company, and this company could. It was just very black and white and easy to understand, quite frankly.
Well, your son-in-law is definitely blessed to have you in his life for a multitude of reasons, but as it relates to this conversation, because I think, and we brought this up, but I think most of the transition from, selling hybrid products, both agency and non-agency, or just movement, from agency to non-agency, a lot of it has to do with training. We both know, you and I know, Lisa, that if your sales staff and your operators are not empowered with whatever the program is, it's going to
Mhm.
falter, and that goes back to the top down concept.
Yeah.
But to have individual like you at their fingertips that can support the training that their organization is already providing, but that empowerment, I'm sure that he knocked it out of the park in his presentation because he had those tools and resources from his organization. You were able to empower him and help him feel very passionate about the products that he was presenting. That makes all the difference. I'd love to get your concept on, like, looking ahead over the next 12 to 18 months. What do you think is coming next for non-agency lending, correspondent lending? And I'd love also your ideas on borrower demand or sentiment.
So it's interesting. We've been talking about this a lot on some of the panels that I've been doing, right? As far as folks have been asking things like, what's the new expansion? Where are the products going? Things of that nature.
Mhm.
And when we talk about non-agency and non-QM, there is like a core peer group, right? There's about 10 of us, 12 of us, company wise, that have been in this for 10 years or more. And we are very proud of the education that we've been putting on for those 10 plus years where, we are the experts. We're at eResi, we're completely dedicated to the space. Like we don't do agency programs, we don't have that in our toolbox. So when we talk about the future, we do talk about it together a lot, like that peer group, especially. Like we all work together, we talk to each
Mhm.
other, and we're all pretty in alignment around not getting too crazy with the programs, meaning that we don't want to see great expansion into 95 or 100% financing. We're not looking to go very low on FICOs. We're not looking to, do a lot of no ratio or none of that stuff. And I think that's important for people to
Yeah.
hear because I want people to understand these are well-heeled, well-performing products for the right borrower. And that's what these are for. And so when I look to the future, I think of just greater adoption, people truly understanding what these programs are. I think giving people more opportunity, borrowers more opportunity in the market. I think that even, our fear in the non-QM, non-agency space is that if there is like another crazy rate cut, that all the people will flood over back to, Fannie and just go rate and term refi everybody in the world. And that will happen. But I think these programs will stick, right? Like they won't forget about these programs. Because I think bank statement, especially, is just so widely used. And there's so
Mhm.
many great tools out there. And it's so easy. And then same thing for DSCR. DSCR programs, they fit for the right borrower, these investors and everything. I think they're becoming part of the fabric now. The largest national companies, if you named any big company, have all the companies pretty much you named earlier on your, they're all doing non-QM. So
President Cuffy. Yeah.
this
Huh.
isn't a fad. This isn't just certain people doing it anymore. Everybody that I work with and big national players, almost everybody on that list wants to do more, not less.
Yeah.
So, that is what I see for the future. I think these people, the products themselves would just get more broadly adopted and give those people the opportunity to own homes.
I love it. That's great. Great talking points. Very, what is the word I'm looking for? Very conservative by nature, which I really appreciate.
Yeah,
This has been such a wonderful conversation, Lisa. Thank you so much for joining us and sharing your perspective. I really appreciate the way you connect to the product and execution and your focus on education. I loved talking to you. Oh my gosh, my friend came and joined me. A my little four-legged friend. Um, Borrower accessibility and affordability. We touched on it all, and your brilliant mind um, brought so much content to our conversation. So thank you for being here. Thank you for all of the support you provide the California MBA and everything you've done for me in my professional life. It's been really fun working with you and engaging with you across multiple platforms. So I want to thank you for that. Um, for our
thank you.
listeners, eResi is focused on helping lenders access innovative, non-agency mortgage solutions and better serve borrowers across the United States with complex financing needs. Um, to our audience, thank you for connecting and tuning in to Connect, where advocacy is consistent, innovation is consistent, and execution is what separates it. Until next time, stay engaged, stay sharp, and keep building with purpose.